Okay. All right. So now we will start things off with perfect competition. All right, perfect competition, and well, it'll be the best if if you see the diagram, you can just draw along with the picture shown, because it's all about like practicing, okay, and everything. So here you are seeing the situation in a perfect competition. All right, so this is representing a firm. All right, so there's one firm here, okay, and we know because of all the components that we see, all the characteristics we see in perfect competition, this is going to be the case. All right, we know they are going to be a price taker. All right, if you are a price taker, you know you cannot really change the price when you are selling your goods, because once you change it, no one is going to buy your goods. Okay, if you change it like $1 higher, all right, people, they will just buy from the other competitors, because there's just so many competitors out there. All right, and the goods, they're the same. All right, when the goods, they're the same, yeah, if you just increase like 10 cents or $1, people, they will go away. All right, yeah, and it will be the best if you just follow what the market is telling you to sell in terms of the price. And now in this case, obviously, is $10. Okay, all right. So if you look at this table here, you will find something very straightforward. Okay, so your price list will always be the same. Okay, the number is always the same. And when you look at the total revenue here on the third column here, all right. So if you have to draw a total revenue, how would you draw it? So what kind of pattern would you describe when it comes to a total revenue? Can you answer me? So now we know, okay, yeah. So when we are like selling different units of output, and we are setting the price at the same level for each unit of output. Okay, it's going to be a linear increase. Yeah, it's a very consistent. Yeah, it's a very consistent trend. All right, when you look at the data here, because yeah, you for each unit that you are increasing for selling, the amount that you will gain, all right, is very consistent. Okay, it's always, yeah, when you're selling 10, when you're selling a one unit, you get $10. When you're selling 2 units, you get $20. Yeah, because it's increasing based on the fixed price here, $10. Okay, so it's a very linear curve. Okay, yeah, very smooth, consistent linear curve right here for the total revenue. Okay, and also, yeah, because we know what marginal is by now. So when you look at the price that they are setting, okay, is always the same price. So when you are moving on from the first unit to the second unit, the extra revenue that you are going to get is always the same. Okay, right? You get it? Yeah, because the first unit you're selling at $10. For the second unit, you're also selling at $10. So the extra revenue that you will gain from selling the second unit is also 10. All right, so 10 plus 10 here is equal to the total revenue of 20. Okay, and so on. 10 plus 10 plus 10 is equal to the total revenue of 30. All right, okay, yeah. So we know how to read this, but you have your equation here just in case when you don't see a one by one increasing order for the unit, then you are going to use the equation here. All right, yeah, the change in TR over the change in Q. Okay, and for your average revenue, yeah, we just knew based on the introduction here, right? Yeah, so when you do it step by step, then the average revenue is just the price. Okay, so basically you will find a very interesting pattern that when you are in a perfect competition, the price, okay, the marginal revenue, and also the average revenue, they are always the same. Okay, they are always the same throughout the entire schedule. Okay, all right. So this is one very important pattern that you need to realize whenever you are trying to draw a diagram for perfect competition. Okay, because they are always going to be the same. Okay, all right, yeah, cool. Okay, so when you are drawing your diagram, okay, this is going to be the case. All right, so so yeah, I think based on the table is pretty easy for you to draw it. Okay, but you can look at it. Yeah, just try to look at the diagram and also look at the table. Right, you see, right, because the three items, they are always going to be the same within the entire schedule. Okay, all right. So yeah, so when we are trying to describe perfect competition, it's always a horizontal curve. Yeah, okay, all right, because whatever quantity that you are going to sell, you will be selling at the same price. Okay, all right, and based on the nature here, you will see the marginal revenue is always going to be the same, whatever unit that you are selling. All right, and at the same time, the average revenue is going to be the same. All right, whatever unit that you are selling, because it's based on the unit price. Okay, all right, yeah. So this horizontal curve here is actually the demand curve. Okay, is actually the demand curve. So you can say, all right, so this line here is representing price. It's also representing marginal revenue. It's also representing average revenue. At the same time, it is just a demand curve. Okay, all right. Yeah. So if people in this market, they're demanding $4, they are demanding 4 units for that particular good, then you'll be earning 40. All right, yeah, and etc. etc. Okay, and when you are trying to look at the total revenue curve, yeah, it's just like what we described. All right, it's a very smooth linear curve. Okay, because you can see the change of TR is very consistent. It's very consistent. Okay, based on the nature of perfect competition. Right. Yeah, I think for perfect competition, it's quite simple. Yeah, it's quite simple. Okay. Yeah, because perfect competition basically doesn't exist. It's only for our purpose of studies. Yeah. So we use perfect competition to see why the other market structures, they are incurring market failure. All right. So this is only used for the theoretical purpose. Yeah, you don't really find any real life example for perfect competition. Well, it's very difficult. Well, we'll talk about that when it comes to perfect competition. Okay. Is there any question so far? Anything that you would like me to explain a little further? Are we all good here? Yeah, so just make sure we don't just make up those numbers. Okay, it's because the pattern that you are seeing here is because we are trying to link it with the nature of perfect competition. Okay, all right. So yeah, so whenever you see perfect competition, this is going to be the case. This is going to be the general case that you are going to use to represent the idea. Okay, all right. Yeah, but now we are going to see something more complicated. All right, so which is imperfect competition. All right. So when you talk about imperfect competition, basically you are looking at a diagram like this. So when you look at the first column and the second column, what kind of diagram? Yeah, what kind of demand curve do you see? Come on, when you see it, just type the answer. Come on. When you look at the first and the second column, yeah, what kind of demand curve it is? So perfect competition is a horizontal demand curve. So it's basically a perfectly elastic demand curve. But here, when we talk about imperfect competition, yeah, right. Yeah, it's a downward sloping. It's a downward sloping demand curve. So it's a normal demand curve. All right, it's the normal demand curve that we have learned. All right, basically, for 2 or more than 2 years. All right. So whenever we're talking about imperfect competition, we are going to use a downward sloping demand curve. Okay, so we are talking about something more real. Okay, something that we see in the daily basis. Because it is the reason, okay, because people, they are now price makers, so they can actually change the price of the goods that they are selling. All right, and that's why you are able to use a downward sloping demand curve. All right, okay, so now you see the difference. Yeah, so this is how we differentiate the two of them. Okay, so one that is a horizontal curve and another one is a downward sloping curve. Yeah, okay, all right. And and for the third column, yeah, you just do the same thing. Okay, whenever you're trying to find the total revenue, just like the drawing I just did, you just have to find that area. You just have to find an area. So it's here, this is the area. All right, so you just use Q multiply by Q, then you'll find the total revenue here. Okay, and for the marginal revenue, yeah, you can just in this case, yeah, when it's going from 1 to 2, yeah, you just have to look at it's just you just have to use 22 minus 12, then you will get 10, right? Yeah, because that is the extra revenue that you're gonna get when you're moving on from the first unit of output to the second unit of output. So yeah, so for the second unit of output, there will be a 10 additional dollars, right, that you will be earning as a revenue. Okay, all right, and so on. All right, and so on. Yeah, so from the second unit to the third unit, yeah, the total revenue is going from 22 to 30. So the additional revenue will be 8 for the third unit. Yeah, etc. etc. Okay, all right. And the average revenue, yeah, just like for perfect competition, it's going to be the same as the unit price. All right, yeah. So when the unit price is 12, yeah, your average revenue is going to be 12. When it's 11, it's going to be 11, etc. etc. Okay, doesn't change. All right. Okay. But here I want you to look at. Okay, I want you to look at the unit price. Okay, the list of the unit price, and also the list of marginal revenue. Okay, so do you think what do you find any pattern here when you look at the price and also the marginal revenue? Can you tell me something that you find out when you look at the two? Is there anything you can tell me when you are comparing? Oh, okay. MR decreases faster than P. Right. So you do see a pattern like this. So this is going to be the general pattern that we will be seeing in imperfect competition. All right. So yeah, you may want to ask yourself like why. Okay. So here I'm just gonna quickly explain like why this is the case. Okay. All right. Yeah. So let's say we are going from 1 to 2. All right. Unit 1 to 2. So listen to this. Okay. When we are going from unit 1 to 2, well, we know how to calculate the marginal revenue. Okay. Yeah. But you may be wondering, okay, when we are selling 2 units, the unit price is 11. All right. But the marginal revenue is $10. So why this is the case? Okay. Because right, when you are selling your second unit, for $11, okay, you will also have to deduct $1, okay, for your first unit as well. Okay, because for your first unit, if you take a look at this, all right, when you are selling 2 units, it means both of the units, they have to be sold at $11. Okay, so that's why for the second unit, when you are trying to sell the second unit for $11, you also have to deduct $1 from the first unit, from $12 to $11. So if you deduct that $1 from the first unit, so it's basically $11 minus 1, which will give you 10. All right. Well, I'll give you another example. So hopefully you will understand more. So let's say when you are going from 4 to 5, okay, 4 to 5, when you're going from 4 to 5, okay, the fifth unit that you are going to sell is $8. All right, but don't forget, for the rest of the 4 units, you are also going to, okay, sell at $8. But before, you were selling them at $9. So for each of the unit, you will have to deduct it by 1. So, before you had 4 units, so each unit deducted by 1. So, here deducted by 1, here 1, 1, 1. So it will be 8 minus 4. All right? So 8 minus 4 is equal to 4 right here. Okay, all right, and if you move on to when you are selling from 5 units to 6 units, it's the same. All right, for the 6th unit, you are going to sell it for $7, but it's not the end of the story, because when you are trying to sell 6 units, for all of the units, you will be selling at the price of 7. All right, but before, when you were selling the units for 5 units. Okay, each of the unit you are selling them. You are selling it at $8. So if this is the case, all right, for the rest of the 5 units, you will have to deduct $1 from each of them. Okay, so because you have 5 units here, so you have to deduct 5 in this case. So 7 minus 5, which will give you a 2. All right, yeah. So if you use this logic here, then you will find out that the marginal revenue decreases faster than the price. Okay, all right, yeah, because of this scenario here. All right, and that is why marginal revenue is always lower than the price. Okay, all right, yeah, in a particular quantity level, All right, so make sure you understand how we interpret the relationship here. Yeah, because this one is pretty important, even though it's not the most technical way to look at why MR is always lower than P. Okay, but this is how we can simply explain. Okay, this is how we can simply explain the relationship between the two. All right, yeah. Is there any questions for that explanation? Are you able to use the explanation to explain for the rest? Are you okay? You sure? Okay. Okay. All right. Okay. Okay. So if that's the case, then you will see. Well, forget about the total revenue here first. Okay. You just have to look at the one at the bottom here. All right. So if this is the case, then your demand curve is always going to be, the price is always going to be higher than marginal revenue, and that's why, all right, your demand curve is always above your marginal revenue. Okay. So this is how we are going to present the idea. All right, because we know, okay, the price is always going to be greater than the marginal revenue. So at the quantity of 2, okay, price is always higher than marginal revenue. At the quantity of 3, price is always higher than marginal revenue at that point. At quantity of 4, price is always higher than the marginal revenue, etc., etc. Okay, yeah, this is always going to be the pattern. Okay, if you really so when you're trying to draw this diagram in general, you just have to draw it like this. I'm just going to quickly, yeah, you can try drawing it, yeah, a little bit, yeah, because otherwise you not be able to suddenly draw the diagrams. Okay, but I would say, look, so it's very general when you have draw your demand curve like this. Okay, so you just have to draw another one that is steeper. Okay, because it's just representing how the price is higher than the marginal revenue at a particular quantity. Okay, yeah. So as long as you are drawing another curve that is steeper than the demand curve, that is going to be the general representation of marginal revenue. Okay, all right, yeah. But you may want to ask, okay, because I just told you when we were trying to explain, why that is the case, why price is always higher than marginal revenue. Well, that explanation wasn't the most technical one. Okay, so if you really want to get technical, even though it's not really required by the curriculum, okay, so you may want to ask yourself a question like how steep I have to draw for my diagram when it comes to ML. All right, so here I'm just going to give you a golden standard. All right, so you just have to draw it. So the ML curve should be twice. All right, the ML curve should be twice as steep as the demand curve. All right, so as long as you are able to get a rough representation of that, you will be just fine. All right, so here, yeah, I'm just going to say it's about right here. All right, so that's ML. It depends on how steep your demand curve is. So let's say now, if I change the slope of the demand curve a little bit, so let's say, let's say more, make it steeper. Okay, so here demand curve. So you just have to make it twice as steep when you're drawing. It's so difficult to draw it here. When you're drawing your marginal revenue. All right. Okay. Yeah. But you know what? I'll let you figure out the math. All right. It's going to be twice. Okay. Yeah. It's going to be twice as steep as the demand curve when it comes to the marginal revenue. All right. Yeah. Yeah. All right. Okay. All right. Yeah. But this is all you need to know. Yeah, the price is always going to be higher than the marginal revenue. Okay. Okay. All right. Yeah. Did you mark that down? Right. So here we will have to do some more explanation when we look at the diagram. All right. When we look at the diagram, with total revenue and also with with normal demand curve and also the marginal revenue. So when we look at them all together, all right, you will see the total revenue when you're using a downward sloping demand curve. The total revenue is always in a shape like this. Well, we talked about this like a long time ago. I hope you still remember that. Well, I wouldn't blame you if you don't remember. But if you remember, can you tell me why? Okay, so why when the price is going down for this, for this part right here, let's say here, yeah, because here when you are moving along the curve, all right, the price is going down. So when the price is going down, the total revenue is increasing. Do you remember like the reason why that is the case? Yeah, you see here, when we are trying to lower the price, okay, when we're trying to lower the price, you can tell, yeah, the total revenue is actually increasing. Do you remember anything? So when we're lowering the price, when we're setting higher quantity, okay, the revenue is going to be increasing and increasing until this point right here. Well, for this one, I wouldn't use the law of diminishing returns to explain it. Okay, so yeah. So now I think I'm pretty sure you guys don't remember. Guys, we learned about PED. Okay, PED for Excel student. We know that along the demand curve, okay, we will see different PEDs. Okay, along the demand curve, we will see different PEDs. And do you still remember? For the top half of your demand curve, what is the PED going to, to look like? Yeah, because you see a transition of PED along the demand curve, if you still remember. Yeah, it's elastic. It's elastic, right? Yeah, so if you know the top half is going to be elastic, are you able to explain like why the total revenue is increasing in the first place? Can someone explain it? Okay, increase in Q is bigger than decrease in P. Okay, all right. Yeah. Okay. All right. So that's the reason. Okay. Yeah, so when you are talking about this part of the diagram, because it's elastic, so when the price is decreasing, it will give you a much bigger increase in quantity. And that is why when you are trying to lower the price, okay, when people they are demanding higher quantity for for the first half of this diagram, the total revenue should be increasing. Okay, should be increasing because this part, the demand is going to be elastic. So when the price is decreasing, the total revenue will be increasing. All right? Okay? Yeah. Okay, are we good here? So, the PED will be, let me use red here. Yeah, so now we're going to incorporate, right, contents from different topics in just two diagrams. So here we would say, okay, PED is, more than one, okay, for this part. And that is why, all right, the total revenue is, is going up. It's going up, it's going up. All right? And you can also find the total revenue will be going up from the marginal revenue curve as well. Yeah, because you remember, marginal revenue is just the additional revenue that you have for the additional unit of good. All right? So, the more unit of good that people they are demanding, the higher the total revenue when you add the marginal revenue together. All right, even though the marginal revenue is decreasing continuously, all right, but you can still see they are all in positive numbers. Okay, for this part here. I mean for this part here. Okay, for this part here. All right, yeah. So if that's the case, look, if you are going from 1 to 2, then you are just going to add up, okay, the marginal revenue at unit 1 and also the marginal revenue at unit 2, which will give you a bigger number for your total revenue for 2 units of goods. All right, and that's why, look, the total revenue is increasing. So, when you see there are positive numbers, then it means when you are calculating the total revenue, it will be increasing. Okay, it will be increasing. So you see here, yeah, they are corresponding to each other, right? So, it's increasing. TR is increasing here. TR is increasing here. Increasing, 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 increasing. All right, until you get to the 7th unit. All right, yeah, because, after the 7th unit, the next marginal revenue that you will get will be a negative number. Okay, so if you also add that negative number into your total revenue, then your total revenue will be going down, okay, when it gets to the 8th unit. And that's why, look, for the 8th unit here, oops, yeah, but here you can see the total revenue is decreasing. Yeah, because when you look at the marginal revenue for the 8th unit, it's a negative number. All right, does it make sense? Okay, all right, yeah. So there you go. So you can explain why total revenue is increasing for this first half using PED, and also using the marginal revenue curve. Okay, all right. So, can someone tell me if this part here is elastic, then what about this point? Yeah, this borderline here. This borderline here at this this point, what would be the PED? Okay, unitary elastic. Okay, so this point right here. So whenever we draw diagrams, okay, when we draw like total revenue diagram and also the corresponding demand curve and also a marginal revenue curve, then we will be able to realize, okay, even though we don't know anything about the level of PED along the curve, but when we compare the both diagram, we are able to find out where when PED is equal to 1. Okay, all right. Yeah, because we know once we have reached the point, okay, once we have reached the point when we have reached the maximum total revenue here, so here's the maximum total revenue, so here your total revenue, okay, will be at the maximum level. So that is basically when you have used up, okay, when you have used up all the marginal revenue, all the positive marginal revenue, right? At the same time, is where when you have reached unitary elasticity. Okay, so at this point, the PED is going to be equal to 1. Okay, so once you pass this point, the next part, okay, the other half of the demand curve, I think we all know what it represents, right? Yeah, okay, it's going to be inelastic, right? So you can tell, when your price is decreasing, but your PED is inelastic, so you can tell the total revenue must be decreasing, right? Yeah, just going back to the basic, when it's inelastic and the price is going down, the total revenue is going to be smaller, okay, because your loss is higher than the gain when you just draw your very simple demand curve. All right, so for the second half, yeah, so if you forgot about this unit here, this Excel unit here, this chapter here, go back to that. All right, so for this part here, it's going to be inelastic, okay, so which means the PED is going to be lower than 1. All right, okay. Yeah, any questions so far? Yeah, I mean, just do your notes, because later on you will have to use all these information in order to help you find some clues when you're trying to answer some questions. All right, so we need to understand all the relationships by now when we are looking at the two diagrams here. All right, okay, to help us later on. Yeah, when there are some very tricky questions, then we are able to use those clues to help us find the correct answer. Okay, all right. Okay, yeah. So once again, this shape here, the total revenue shape here, you can be explaining the shape here using elasticity, PED, and also using your marginal revenue, okay, the pattern of your marginal revenue, right? And I just mentioned the technical way to look at the slope of the marginal revenue, yeah, is twice as steep as the demand curve. Well, basically, this is how you can find the marginal revenue is twice as steep as the demand curve. So if you are able to find the slope of the total revenue, then you'll be able to find out the answer. Yeah, because when you look at marginal revenue, the equation is the change in total revenue over the change in Q. All right, so if you're interested, yeah, so once you are able to find the slope of the total revenue, that's going to be the function of your marginal revenue. Well, yeah, it's not in the curriculum. All right, if you if you don't know what I'm trying to say, then it's okay. Yeah, just stick with that golden standard. Okay. Yeah. So if you have your demand curve, just draw a marginal revenue curve that is twice as steep. Okay, roughly. All right. So there you go. Yeah. Simple. Okay. All right. Yeah. So there you go. Is there any questions? Yeah, I mean, this part here, yeah, you may need some more time to digest. Uh, I suggest you either go back, to this part, or the other part when we were talking about the costs from time to time. Yeah, because is it could be quite easy to forget. All right, sometimes when you get all the technical elements all over the place. Okay, all right, right. Any questions? Are we, you good? Yeah, I mean, if you see any questions, yeah, just feel free to ask. Okay. Okay, right. So there you go. Okay, so this is how we draw the demand curve for imperfect competition. Okay, so this is for imperfect competition. And so see, once again, demand curve is always above the marginal revenue curve. Demand curve is always above the marginal revenue curve based on the very simple explanation I just did. If you are a more like a mathematic kind of person, then yeah, there's another way to explain it. But usually, yeah, we just use the first explanation for for the relationship between the two. Okay, all right, and you can see all other things that give you insight within the two curves. Right, you can see different PEDs, and from different PEDs, it will tell you why the total revenue is acting in a certain way. Yeah, it's going to be increasing and then decreasing here, and also when you look at the marginal revenue, yeah, it will give you, yeah, it's the same idea. Okay, all right, right. Okay, so that's basically revenue and cost. Okay, okay, all right, yeah. So once we have learned all the curves for revenues and also costs, then we can put the two together. Okay, so when we put the two together, what can we find out? When we put the revenue and cost together, what can we find out? Come on, so now you have your revenue and you have your cost. So what possibly would you be able to find out? So maybe you are now looking at when there's a particular, yeah, when there's a particular unit of quantity that you're looking at, and you have your cost and you have the revenue. Of course, you are able to find out the profit. Okay, so if you put all of them together, you will be able to find your profit, and that's why this part here, yeah, we are just going back to the basic objective of the firms. All right, for basically all the firms here, we all look for profit maximization. Okay, yeah, so we just have to look at at which unit of output we will get the maximum profit. So this is how, yeah, we can find it from the diagram. All right, and there are two methods. You can use total revenue and cost approach, or you can use marginal revenue and cost approach. So basically, you are comparing the total revenue to your total cost if you're using the first approach, and you are using the marginal revenue and the marginal cost to find out the profit maximization. Okay, for the second method. Okay, yeah, we'll go to each method one by one. Okay, and for the first one is pretty simple. It's pretty simple. Yeah, because we know when you have your total revenue for a particular unit of output, and you have the total cost for a particular unit of output. When you do the calculation, yeah, all right, how much profit that you earn when you are producing that particular unit of output. Okay, all right, yeah. So, but before we go to the first approach, there are some terminologies that you need to learn. Okay, so from now on, you need to stick with these terminologies. Okay, all right. So, if you have compared the total revenue, well, whatever, the revenue and the cost, and you find out there is a zero profit, so which means when the revenue is equal to the cost, then we would say that is a normal profit. All right, okay. So if you have gained zero profit, then you will say that's a normal profit. All right. But if the profit is more than zero, then you will say it's an economic profit. Some people, they would say it's a supernormal profit, and some people, they would say it's an abnormal profit. There are just too many terminologies. We're just going to stick with the first one, economic profit, right? But if you want to use the second or the third one, yeah, be my guest, because they're the same. All right, okay, yeah, there are just too many terminologies in economics for one simple idea. So there you go. All right, and if you are incurring a loss, so when your cost is higher than the revenue, then you just call it a loss. Okay, or you just call it a negative economic profit. It's the same thing. All right, okay. So yeah, so from now on, I want you to remember all the terminologies here, because you'll be using the terminologies very often from now on. Okay, all right. But I would say this is going to be the most important terminology that you need to remember. Normal profit, yeah, when when the cost is equal to the revenue. Okay, all right, yeah. So yeah, we all understand what normal profit is now. So basically, when you are gaining a normal profit, we would say we are at a break-even point. Okay, yeah, a break-even point is basically when you just like make a draw. Yeah, when you barely make a draw. Okay, you don't win, you don't lose, you just make a draw. Okay, all right, yeah, so that's a break-even. Okay, and when you're looking at the first approach, you will get break-even when the total cost is equal to total revenue. So if you put Q on each side, all right, yeah, use the TC over Q and also TR over Q. So basically, you can see, this in another interpretation. So when AC is equal to P, that is also a break even. All right. So this is also telling you, when your unit price is equal to your average cost, okay, which means your average profit is going to be zero. Okay, and if your unit price is higher than the average cost at a particular unit, which means your unit profit is more than zero. Okay, yeah, you can look at the profit in different ways. Okay, you can look at it in total profit. You can look at it in average profit. It's the same. Okay, all right, right, yeah. So there you go. Yeah, you just need to realize, okay, the different terminologies by now. All right, yeah. So economic profit, we all know what that is, all right, by now. So a very simple diagram, putting everything together. Here, can you tell me what kind of competition this is? So you only have perfect competition, imperfect competition. What kind of competition this is? Yeah, Brandon. Yeah, right. Yeah, you just have to look at the total revenue, and you will find out the answer. Okay, yeah, because the only perfect competition will give you a pattern of the total revenue like this. Okay, when you go to imperfect competition, the total revenue won't be looking like this. Okay, all right, yeah. So we are certain this is talking about a perfect competition. Okay, it's a perfect competition. But when we look at those 2 points here, what are we trying to say? So the intersection point. Yeah. So here we're talking about when we are producing at this output. Okay, when we're producing at this output, we see there's an intersection between the total cost and total revenue. So what does it mean when we are producing at this output? Okay, yeah, so there you go. Yeah, right. As long as you're able to use the terminology, there you go. All right. So we are having a normal profit here and also here because the total cost is equal to the total revenue. So at this point, at this output here, or at this output here, okay, you will see a break-even point. Okay, you will see a break-even point. So which means if you are producing at this output or that output on the right, you will earn a normal profit. Okay, all right. But what about this part? Okay, if you are producing any output within this part on the left, what is the outcome? Come on. On the left. Come on, if you know it, just tell me. Come on. If you're producing any output, right, there's a loss, right? Yeah, because you see here, if you look at this part, any output at this part on the left, the total cost is always higher than the revenue at each output. Okay, yeah, you see here, always higher until you reached break-even point where you will earn a normal profit. Okay, so yeah, let me just wrap it up. Okay, right. So can you quickly tell me what about the second half here? What are we going to see? Any output that we are producing at the second half of this diagram. Yeah, so from here, yeah, there will be economic profit. All right, so make sure you use the terminologies. Okay, so because you see here for the second half of this diagram, okay, whatever output that is in the second half of this diagram, all right, when you are producing at that output, the revenue is going to be higher than the cost, and that's why, all right, for this part, you will always earn a profit. And as a firm, of course, you want to aim at output within this range. Yeah, you want to aim at the output within this range. And once you pass that range, you will get back to a loss position. Okay, so when you look at the third part, the cost is once again higher than the revenue. So for this part is a loss. All right, okay, but let me just ask you the very last question before you go. Okay, when you look at the second half of the diagram, okay, where would you see profit maximization? Come on, if you finish this question, then you are good to go. For the second half, we know there's a profit, but which part of the second half? Okay, which part here? Okay, I think that's more specific. The biggest difference between the revenue and the cost, right? And that's how you get okay, that's how you get this profit maximization. Because here, look, the revenue and the cost, they have the biggest difference. So when you are doing your calculation, then you will see for this output at this point, you will get the maximum profit. Okay, all right, yeah, because the cost and the revenue, the difference is the greatest. Okay, it has the greatest difference between the total cost and the total revenue, and that's how you get profit maximization at this output. So as a firm, you always want to find yourself producing at this position. Okay, well, I don't know what this unit is. Well, it could be either Q1, so you always want to produce your goods at Q1 because that will give you a profit maximization. Okay, all right, yeah, right, yeah. I think I'm just gonna end it here. Okay, Right. So next week when we come back, then I'll give you some practice. Okay. So to help you refresh some memory. Okay, when it comes to so many different curves and numbers. All right. Okay. Yeah. So now I'm just gonna let you go. All right, guys. Yeah. Go take a break. Bye. Bye, guys. Bye. 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 Bye.